Let's get started. Before I begin, can everyone see my screen?
Yep.
Perfect. Okay. I wanted to start off with perhaps some more prominent recent developments. As we've seen over the last few months, the US administration has placed a series of tariffs across multiple countries and across different products. Now, for Canada, this has really meant new tariffs on things like steel and aluminum, as well as some auto products. Now, to put the US tariff increase in perspective, we're estimating that the new average effective tariff rate that the US is facing on its imports is somewhere between 15 and 20%. Now, to put that in perspective, that would actually put it at the highest level since the 1930s. Now, while we do think that the tariffs on certain Canadian sectors are significant, especially given that historically the tariff rates have been very low or near zero, the good news is that Canada actually faces the lowest average effective tariff rate on its exports when compared to some of the other US trading partners. Now, we think this largely reflects the CUSMA Free Trade Agreement, which has largely shielded the majority of Canada's exports to the US. Now, we know that the US is in a government shutdown, so there has been a lack of timely trade data. But looking at the most recent available trade data for July, we can actually see that roughly 90% of Canadian exports have entered the US market duty free. And if we look back even further at the previous few months, we can actually see that that share has remained fairly consistent over the last few months. Looking at the impact of US tariffs on US economic growth, we can see that it did create some significant turbulence in the US economy earlier this year. We saw both businesses and consumers engage in what's known as tariff front running, which essentially means a ramp up in imports to avoid tariff induced price hikes. Now, this ultimately led to a contraction in first quarter US GDP. Now, while we did see a rebound in the second quarter and expect some of that strength to kind of flow into Q3, our expectation is that as tariffs continue to weigh on the US economy, it will show up in US economic growth numbers both later this year and into next year. So our projections for the US economy really see it advance by roughly 1.8% this year and around 1.6% next year. And that would mark somewhat of a significant slowing from the above 2% pace that we saw just last year. Now, although most Canadian exports have continued to flow to the US somewhat duty free, the products that have been specifically targeted, like steel, aluminum, some auto products, have seen material drops in their exports to the US. And this has actually weighed significantly on certain industries in Canada, like the manufacturing sector. And while Canada has had its hands full with US trade announcements, we've actually seen a rise in tensions with another of Canada's major trading partners, China. So over the last few months, we've actually seen China implement tariffs on some Canadian exports of agricultural products like canola and seafood. Now, while this might not be as concerning for a province like Ontario, which may face more pressure or exposure to the US tariffs, the Chinese tariffs could weigh more significantly on provinces in the prairies and in the Atlantic, which rely more significantly on the Chinese export market for agricultural exports. For example, China is actually Canada's largest export market for canola seed, and just last year we exported roughly 4 billion in total value in terms of canola seed. China is also Nova Scotia's second largest export market for lobster based off of 2024 trade flows. Now, although Canada has fared comparatively better than expected to date, The uncertainty surrounding volatile trade announcements has created a significant impact on both consumer and business confidence. Taking a look at consumer sentiment survey data, we can see that sentiment actually reached record lows earlier this year. And while it has recovered from those levels recently, it still remains significantly lower than the long run pre pandemic average. Now, we think this is notable because it can have material consequences on the broader economy. For example, for consumers, it could lead to reduce or postponements in spending, especially for big ticket items like housing. Whereas for businesses, it creates significant challenges for long-term planning and investment decisions. And if we actually look at some of our internal RBC card holder spending data, we can see that household spending has been resilient so far this year, but Q3 did show some signs of moderation in spending. Now, another significant concern lies in how the uncertainty caused by the trade war could weigh on already weak Canadian business investment. I'm sure we've all seen in recent news a multitude of companies across different industries announce delays or outright cancellations of major investments. And this has been particularly pronounced in highly trade sensitive sectors like Canada's manufacturing sector. Now, we think this is notable because while this might pose some downside risks to Canada's short-term economic outlook, it could also have serious long-term implications in that lagging investment really risks extending Canada's already ongoing trend of weak, low capital spending. And if we actually compare Canada to the US, we can actually see that Canada invests significantly less per worker than the US does. And this has really contributed to weaker productivity and a lower potential economic growth over time. Shifting our focus to the housing market, we can see that the uncertainty caused by the trade war did cause a steep slowdown in home buying activity earlier this year, before we saw somewhat of a rebound throughout the summer. However, with the latest data coming in from September, we have seen kind of a drop in home buying activity, with home resales declining for the first time in September since April earlier this year. Now, we think that is because of US tariff announcements in both August and September. The US had announced tariffs on lumber as well as copper. So we think that kind of undermines some of that buyer confidence once again. Now, it is important to note that while the uncertainty has caused pressure on Canada's overall housing market, the impact has varied significantly by region. So, for example, in regions where there's perhaps some stretched affordability, like in Ontario and in some parts of BC, home prices have actually been declining. In contrast, in some other markets, like in the Atlantic provinces, those markets have actually held up much better. And we've actually seen home prices continue to see upward pressure due to persistent demand. Um, Now, going forward, we do expect that house resales will gradually recover as lower interest rates and lower prices in some markets stimulate more buying activity. But we do think that process is likely to be bumpy, just given the current economic uncertainty surrounding trade announcements. Now, with a lower average effective tariff rate on its exports compared to some of the other U.S. trading partners, coupled with a somewhat resilient U.S. economic growth outlook, we think Canada's economy has been tracking relatively better than expected just a few months ago. So overall, we expect Canada's economic growth to come in at around 1.2% both this year and next, which would be slightly slower than 2024. Now, while Canada's economy has so far avoided a more prominent downturn, the trade war has put Canada's growth potential on a somewhat structurally lower path than it would have been outside of the trade war. It's also worth keeping in mind that there is considerable uncertainty regarding Canada's outlook. Um, if tariff policies, for example, escalate against Canadian exporters, we could see some further downside risk to the outlook. Now, the good news is that inflation in Canada is currently broadly in line with the Bank of Canada's 2% target and significantly lower than the levels that we saw during the pandemic. Now, our baseline forecast assumes that inflation will average around 2.1% this year and roughly 2.2% next year. Now, looking at inflation on the US side, we've actually seen inflation steady and core inflation, which excludes some of the more volatile components like food and energy prices, has actually been at 3% as well. Now, we think that as tariffs continue to flow into higher US consumer prices, we expect to see US inflation average around 3% early next year and around 3.5% for core inflation. Now, given the softening in Canada's labor market, as well as a weaker growth outlook and relatively contained inflation, we've actually seen the Bank of Canada step off of the sidelines back in September to cut interest rates down to 2.5%. Now, we do expect that the Bank of Canada will follow up with one more 25 basis points cut later this week, which would bring the policy rate down to 2.25%. And that would be before moving back to the sidelines. Now, as we've seen with US tariffs putting significant pressure on certain sectors in Canada's economy, the Canadian federal government has announced some fiscal support for those targeted sectors. So we really think that the Bank of Canada is likely to watch for the impact of those policies before deciding on further rate cuts. Now, in contrast, looking at the US Fed, which had been remaining in somewhat of a wait and see approach for several meetings, we saw softer than expected employment trends as well as potential downside risks from the tariffs prompt the Fed to begin cutting its interest rates. Now, while we do expect the Fed will continue to cut its rates with another penciled in this week and then perhaps another two early next year, we do see that rising core inflation pressures as tariffs feed into higher prices, really ultimately limiting additional rate cuts in 2026. So based off of that, our expectation for the US policy rate is for it to settle somewhere around 3.5% in 2026. Now, given that US long-term yields are expected to remain elevated due to broader inflationary pressure, we actually see Canadian long-term yields also following suit and drifting slightly higher going forward. Now, this is important because a lot of major purchases and investments are tied to longer term yields, and that could continue to weigh on their demand. For example, longer term rate mortgages in Canada might see weaker downside potential, and that could create some additional challenges for some housing markets that have already been facing some household affordability issues. Now, to date, we have seen some improvement in affordability with the Bank of Canada's rate cuts. Now, while this is welcome, we don't expect that further rate cuts from the Bank of Canada will fully offset the sharp rise in ownership costs that some markets have experienced since the pandemic. Now, a primary factor really driving that rise in ownership costs has been the supply and demand imbalance in the housing market. So, limited housing supply coupled with strong demographic demand has really placed significant upward pressure on home prices in recent years. And while some home prices have begun to decline in some markets, they have remained significantly higher than the pre-pandemic levels. We also need to keep in mind that the lower interest rates have mainly benefited households with perhaps variable rate mortgages. In contrast, many Canadians with 4 or 50-year fixed rate mortgages, which were really secured during the record low rates of the pandemic, are experiencing a different challenge. So when these fixed rate contracts come up for renewal either this year or next, they could experience significant payment increases due to today's relatively higher interest rate environment. Our expectation is that for affordability to continue to improve, there is the need for continued home building activity. Shifting our focus to the Canadian dollar, we can see that the Canadian dollar had experienced some depreciation against the US dollar in the weeks leading up to what the US touts as their Liberation Day announcement. And since then, it has shown some modest gains. Now, we believe some of that CAD strength has been driven by factors like expectations of narrowing rate differentials between the Bank of Canada and the US Fed, as well as potential downside risks to US economic growth. Now, while there is considerable uncertainty with regards to our currency outlook, we're projecting that the CAD will stabilize somewhere around 73 cents US by the end of this year and trend slightly higher to around 76 cents by the end of next year. Now, the US tariffs have impacted specific sectors in Canada, and as a result, we have seen Canada's labor market weaken so far this year. We've actually seen the unemployment rate rise roughly 0.5 percentage points to 7.1% since the start of this year. Now, part of that is attributed to a slowdown in business hiring, as well as some layoffs in targeted sectors. Now, another factor is Canada's recent demographic growth. So we've seen in some regions that significant population growth lead to really a labor force growth that's outpacing job creation, and that has contributed to a rising unemployment rate in some regions. Now, while we are seeing some softening in Canada's overall labor market, taking a look at recent data from job postings, we can actually see that, or I guess job postings data recently has been pointing to somewhat of a stabilization, and that really kind of feeds our expectations in that the unemployment rate may be stabilizing before drifting slightly lower next year. Digging a little bit deeper, we can actually see that most of the job losses to date have largely been concentrated in highly trade exposed sectors like the manufacturing sector, transportation, and warehousing. In contrast, some of the other sectors of the economy have actually seen some job gains. Now, in provinces which face comparatively lower tariff exposure, we've actually seen greater resilience in their labor markets with lower unemployment rates as a result. Now, given the US administration's approach of targeting specific sectors and industries, the outlook for the provinces has varied significantly. For example, some of the manufacturing heavy provinces like Ontario and Quebec are expected to underperform other provinces and nationally both this year and next. Now, in contrast, some of the provinces with somewhat lower exposure to the US market, like some Atlantic provinces, are expected to perform relatively better both this year and next. Now, with declining household affordability and an employment market that has really been struggling to keep pace with rapid population growth, we've seen the Government of Canada impose new federal immigration targets over the next few years to really slow that pace of population growth. Now, the aim of these new targets is really to ease pressure in certain sectors like housing and some public services by allowing supply to gradually catch up to persistently high demand levels. Now, in particular, the federal government is really looking to reduce the share of non-permanent residents as a share of total population from over 7% in 2024 to around 5% by the end of 2026. With these new effectively stalled. And that actually, Q2 actually marked the fifth consecutive quarter of slower population growth in Canada. Now, most of that population slowing reflects a decrease in the number of non-permanent residents. Both in Q1 and Q2 of this year, we actually saw net reductions in the number of non-permanent residents overall. Now, given the slowdown in population growth due to the new immigration targets, we're expecting that Canada's population growth will grow by roughly 0.9% this year before effectively stalling in both 2026 and 2027. Now, our assumption of slower population growth over the next 2 years assumes that the adjustment of non-permanent residents will likely take longer than the government expects and extend into 2027. Now, their goal is to reduce non-permanent residents down to 5% of total population by the end of 2026, but our expectation is for that to kind of lead into 2027. Uh, Now, while this, while we do think that this might provide some near-term relief to both the labor market and housing demand, it is important to keep in mind that it could have some long-term implications for Canada's economic growth. For example, without sustained immigration, population growth will no longer serve as a key driver of economic momentum that we've seen in recent years. In addition, it also risks transitioning Canada's population back to an aging trend. And actually, if we look at recent data from Q2, we can see that the median age in Canada has actually started to rise again as the number of non-permanent residents declines. Now, the combination of slower population growth as well as some existing challenges like weak business investment could really contribute to softer economic growth in the longer term. Now, given Canada's reliance on the US market and the significant impact that the US tariffs are having on certain sectors certain industries in Canada, there has been a renewed urgency for Canada to diversify its trade. Now, to date, we have seen the federal government make efforts to deepen Canada's existing trade relationships as well as seek out new partnerships. Looking at recent data um, in light of the trade war, we've actually seen an increased share of exports flowing to non-US destinations, which could indicate some early progress. Um, and in addition to sort of looking at international markets, we've also seen renewed urgency to look within and address some internal trade barriers that have hindered trade between provinces. So I'm sure we've all seen in recent months there has been several initiatives to address those trade barriers. For example, some provinces have signed memorandums of understanding. And really, those are just agreements on the mutual recognition of goods, services, and labor credentials. We've also seen Bill C5 come out of the federal government. And Bill C5 really seeks to streamline interprovincial trade by recognizing comparable provincial requirements as meeting federal standards. Now, while we do think that these efforts are welcome, it is important to note that the expected gains from removing internal trade barriers are likely to accrue over the longer term. So it's unlikely that the removal of these internal trade barriers will fully offset the short-term loss of market access from the US tariffs on Canadian goods. Overall, although we do see internal trade barriers supporting economic growth, it is not a silver bullet solution for Canada's trade troubles. We see it as being more part of a broader strategy, which also includes strengthening global trade relationships, boosting business investment, as well as building infrastructure to move goods both across Canada and abroad. I just want to end by saying that the path forward remains highly uncertain. And here at RBC Economics, we are continuing to monitor these developments very closely. For anyone interested in more detailed analysis on the themes I've presented today, I would strongly encourage you to visit our website. And thank you.
Okay, thank you so much for that wonderful presentation, Salim. Um, Perhaps I'll stop recording at this point, and